Hey, let's say you want to leave a legacy for your family, or really anyone for that matter. Which is better, a Roth IRA or life insurance? Both of them are typically tax-free, so what's the difference? Which one's better? Let's go over it next. Hey everyone, I'm Mel Stubbs. I'm a financial planner with Christy Capital Management, where we help a select group of clients with their financial planning and money management. If you want to reach out to us, go to christycapital.com and click Talk to an Advisor. Today I'm going to talk about which is the better choice for legacy, a Roth IRA or life insurance. You know, a Roth IRA is a retirement savings account that allows you to contribute after-tax dollars. The money in the Roth IRA grows tax-free, and you can withdraw it tax-free at age 59 and a half as long as you've had the Roth IRA account for 5 years. So that makes Roth IRAs a great option for leaving a legacy because your beneficiaries will not have to pay taxes on the money they inherit. But now with the Secure Act 2.0 that they just passed a year or so ago, they've changed the rules on how beneficiaries inherit Roth IRAs. Now, if you inherit a Roth IRA from your spouse, the IRA lets you treat it as if the funds are yours, and you can roll it over into your personal Roth IRA and therefore not have any required minimum distributions, and the money can continue to grow tax-free in your Roth IRA account. Now, if you inherit a Roth IRA from a non-spouse, then the new 10-year rule generally applies. And that just means that the Roth funds have to be withdrawn from the Roth IRA account by the end of the 10th year. The IRS puts a limit on how long you're going to get the tax-favored benefit. You know, back in the day, you could stretch it for a long time and enjoy some tax benefits for your lifetime. So potentially 30, 40, 50 years even. You know, not anymore. So if you're not a spouse, there's a 10-year rule. Now with life insurance, the death benefit is typically tax-free. So on the surface, you'd see that the Roth IRA is tax-free and the life insurance death benefit is tax-free, so they'll be the same, right? Well, let's go over some of the nuances. With life insurance, the death benefit is tax-free. The beneficiary would receive the money tax-free. Then they'd have to place it in a non-qualified account, meaning an account that does not have tax-deferred or tax-free benefits. As that money starts to grow, there would be capital gains on the account. If you think back to the Roth IRA that you inherited, you have that 10-year rule of leaving the money in the inherited Roth IRA for 10 years. That means the Roth IRA is going to get 10 years of tax-free growth, but for the life insurance, that'll have to start paying taxes on the growth immediately. So from the beneficiary's point of view, inheriting an equivalent amount of Roth would be considered better than inheriting the same amount of life insurance. Now, if you think about what it took to generate both of these accounts, you know, with Roth, you had to contribute or do Roth conversions to get the account funded. With life insurance, you can just make premium payments to have it funded. A Roth IRA generally takes years to build up a significant value. But with life insurance, you can just open up a policy and you can have a guaranteed death benefit paid immediately at your death. So which is better? Instead of thinking of which one is better, let's envision them as tools in your tool belt. Let's say one is a hammer and one's a screw gun. They do similar things, but they are different, and so different situations may make a hammer more valuable. Some situations may make a screw gun more valuable. But if your workshop is anything like mine, you probably have both. So try to have all the Roth you can. We have lots of other videos on doing Roth conversions and trying to build up very substantial Roth accounts. But what if you have a bunch of non-qualified money, just regular old money out there, and you don't really know what to do with it? If you want to leave that money as a legacy, it may make sense in some cases to run the money through life insurance to multiply it. For instance, let's say you get a $500,000 life insurance policy that's never going to run out. It will be payable no matter when you die. You start funding it with the regular non-retirement money. Most all life insurance policies are going to pay out more at your death than you would have ever put into it. That's the multiplying effect. So should you have a Roth IRA in your portfolio? For the vast majority of you, I would probably say yes. Now please talk to your own professional tax advisor or financial planner to help figure out that question for you. But for the most part, there is some value in having some tax-free money. Should you, if you're legacy-minded, have some life insurance in your portfolio? I mean, if you're legacy-minded, I would argue that you probably should. I heard an old saying that said, life insurance allows you to buy dollars with pennies. So if you're unsure if you have your money in the right portfolios, or maybe even in the right buckets, like how much non-qualified should you have? How much traditional should you have? How much Roth should you have? Reach out to us at christycapital.com. But until then, check out this video right here. Can you have too much in the wrong accounts? It'll shed some light on how much you should have in each of the different buckets of money. My name is Mel Stubbs. I'll see you on the next video. Thanks for watching.